Good morning and welcome this morning to Long Verticals and Diagonals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend Michael Fairborn, 20-plus year veteran of the financial markets, great educator, and he's going to be there to help answer your specific questions along the way. Thank you for joining us, whether you're joining us in the live version or the recorded version. We appreciate you being here. We're grateful for you. And participate in the discussion. Jump into the chat, leave questions in the comments section. We would love to hear those comments and questions along the way. So today, as we talk about long verticals and diagonals, we've got kind of an interesting market. It's kind of poised at a level of support, perhaps at a little bit of a level of resistance, maybe kind of toggling sideways here. So we're going to take a look at that. And we're going to put that into the context of long verticals and diagonals in the direction of individual stock movement, not necessarily what the whole market is doing. And by your request, we might take a look at a real quick, long vertical, 0 days till expiration example, if we have time to do that. So we'll jump into that here really quickly. And as we get started, a couple of quick housekeeping items. Remember, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of advice or endorsement. Also, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions and spread trading, like what we are talking about. Long vertical spreads, long diagonal spreads must be done in a margin account, so be aware of that. Also, we're going to use technical analysis as part of this discussion. It is not a guaranteed future success, neither is probability analysis or fundamental analysis. They are all theoretical. Schwab doesn't recommend the use of technical analysis or any other type of analysis as a sole means of investment research. Yeah, we're going to be using the Thinkorswim desktop software platform today. It is a great learning environment. However, it is not a guarantee of future success out there in the real world, at least the paper money version. And that being said, there are some differences between paper money and live trading as well. Paper money trade, the paper money platform does not facilitate the early assignment of short options. Anytime you're short an option, if it's an American style option, then there is the potential to be assigned early on that short option. Paper money doesn't do that. So that's something to pay attention to when you move from paper money to live trading in your practice. Now, if you're trading index options, generally index options, which we may talk about today, those are European style. Those can only be exercised at expiration. So that takes out of the equation that part of the discussion. But something to pay attention to. Remember, investing involves risk, including loss of principal. We're going to talk a little bit about the idea of possibly using stops or limit orders or stop limit orders. So be aware of the fact that stop limit orders, we can specify the activation price, but not the execution price. And in the event of a stop limit order, there's the potential that the price could move around that limit area and the order not get filled at all. So let's jump into this discussion here really quickly. Just a quick reminder of where we're going. We're going to talk about long verticals and diagonals. We're going to talk about what's going on in the market. We'll discuss the impact of price, time, and volatility. We will look at some examples. And so as we jump into this discussion, I'm going to switch over to the Thinkorswim desktop software platform. And again, this is the paper money version. This is my demonstration account, so it looks like a live trading account. It is not. I assure you, I don't have $16 billion of trading buying power in my live trading account. So this is a demonstration account. But taking a look at the market, remember I said the market's kind of been toggling sideways here. It's just kind of been going up and down off of this little bit of a support area. In this case, the 5873 on the SPX. And we get a little bit of a bounce today, a little bit of a gap up and a sell-off, but we've got a long tail to the downside. So there's been some downward pressure moving in that direction, but at the same time, we have the RSI continuing to move to the upside. So very, very short term bullish divergence here. If we've got that downward pressure, we've got RSI moving higher, that may be an indication that maybe there's a little bit of buying pressure coming up off of this level of support. And we're seeing that also in the candle. We take a look at the NASDAQ. now following things like the NVIDIA earnings, and we've got some retail earnings that have been coming into play here. And we see that little bit of a gap up in the sell-off, but once again, that push to the upside. I'm going to draw on that level of support on the NASDAQ kind of right about here. Overall, trend is still very bullish, right? We're still coming up off of this very strong 50-period moving average, the 200-period moving average still motoring higher. RSI, though, in this particular case, kind of backing off just a little bit. And we take a look at the Russell 2000. Small caps perhaps seeing at the moment, at least, the greatest amount of push to the upside in this particular case. Starting to see that move to the upside, kind of breaking out through that little bit of a resistance. So we talked a little bit about this 2 days ago in my trading flag patterns class. We talked about it yesterday in the Protective Strategies webcast. And now starting to see a little bit of that strength coming in terms of some of those small caps, at least in a more bullish direction as we get into the end of this week. And as we get towards next week as a holiday week, and talking about how we might see that volatility is a little bit increased, but that volume's overall a little bit lower. Let's go ahead and take a look at the VIX grid here. And so one of the things I wanted to bring up is the idea that when we're talking about long vertical spreads and long diagonals, the big driver of that trade, either side, either a long vertical or a long diagonal, is in the name of the trade, right? The long leg. It's the long leg is the driver. So when we're long an option, this is a really quick quiz. When we're long an option, is that long option theta positive, or excuse me, Vega positive or Vega negative? Remember, Vega is the option Greek that gauges the sensitivity of an option premium to movement in implied volatility. So as a long option, whether it's a long call or a long put, is that Vega positive or Vega negative? Yeah, Vega positive always on long legs, right? On long options. So low and rising implied volatility can be our friend as a trader of long vertical spreads, long diagonal spreads, but it's offset by the short leg, right? Short leg, a short option, always Vega negative, right? Rising implied volatility is always going to work against that. So we kind of have to balance those forces here in this particular scenario. But what we were seeing, at least at the moment, has been a low and rising implied volatility. Low and rising implied volatility. Now, not that it's spiking. We're not seeing this carry trade unwind spike or the pre-election spikes that we saw. What we're seeing here in this particular case is we're starting to see that just kind of general drift higher into the end of the year of implied volatility, and it typically tends to go that way, right? We typically tend to see maybe a little bit more uncertainty, and oftentimes, certain things, certainly after an election, we saw a bleed off of that implied volatility, but it's coming back a little bit, right? We're starting to see that generally low and rising implied volatility, right? So, good question. Berkshire asks a great question here, which is, what is a normal time span for a long option? Really good question, because it can vary, right? Typically, we talk about the idea of, if we're buying a long option, buying enough time that theta, the option Greek that governs or gives us a sense of the sensitivity to the passage of time, that theta becomes less of an issue. Theta increases as we get towards expiration. Vega, on the other hand, volatility sensitivity decreases as we get towards expiration. So buyers of options, long options, typically may buy a little bit further out in time, but we don't have to. And this is an interesting concept, and I'm glad that you brought this up. I'm going to use this. So I'm going to use this as kind of a blackboard, if you will, for this discussion. Let me grab my magic marker for just a second here. And we've talked about this before, right? We've talked about this curve here in terms of theta, right? This curve towards expiration, this time decay curve, because time decay is going to work to a greater degree on our long options generally than it is on our short options, simply because it's working against us, working for us in the short option case, right? But notice that this curve kind of looks like this. It's a logarithmic curve, right? In fact, it's even a cross section of a Fibonacci spiral, which is something I didn't know until I started digging into the math the other day. But this is price over here, right? And this is time to go until expiration. But what I've come to realize as an option trader is that any particular time slice, one of the great things about mathematics is we can dig into the fractal nature of some of these calculations, right? Remember, this is all theoretical in general. But what I've come to realize as an option trader is that any time slice that we take, right, of this curve tends to be fractal. Now, normally we would look at this, right? We would look at buying an option out here if we were the buyer of an option, and we would look at selling an option here after the curve starts to accelerate if we're the seller of an option. But you know what kind of occurred to me, and I mathematically confirmed this, and I talked to my dad about this, who's a biostatistician. I've talked to a couple of other mathematicians about this. But if we were to put a magnifying glass, I'm just going to use this as my magnifying glass icon, right? If we were to put a magnifying glass on any segment of this time decay curve, that theta decay curve, and we were to take that and we were to expand that out to see what it looks like, right? If we were to just put the magnifying glass on this little segment right here, here's what that curve is going to look like at any particular point in time on this curve. Assuming an at the money option, this curve is going to be fractal. It's going to look the same. So what that means for us as option traders is this. Not that everything that we've learned is wrong, because it's not. It's absolutely correct. But what that means is if we shift our time focus from days to minutes or hours or whatever, we still get the same relationship. If we shift our time focus from being the buyer of an option way out here on the curve and the seller of an option here on the short end of the curve, what that means is if we're doing, let's say, for instance, a diagonal spread, we can create that diagonal spread here and here. So we could buy here on the curve and sell here on the curve, and we're still going to have that same relationship, right? We're still going to have that same fractal relationship of the short end of the curve accelerating. I don't know if any of this made any sense at all, or if I've just kind of confused everybody, but it made sense in my head. So hopefully it made sense to you as I've explained this, because I thought this was really cool that this theta decay curve, and you guys are the first ones I've talked about this with, because I thought this would be a good opportunity to talk about it. But this theta decay curve is fractal and becomes similar when we start to look at smaller time slices of it, right? Okay, so that being the case, to kind of now kind of come back from this rabbit hole tangent that we've gone down in this discussion, what's the normal time span for a long option? Well, that depends. So we put everything into balance. And George's answer to the question is absolutely correct. If we were looking at days to go until expiration, theta greatly accelerates, right? Past that 30 days to go until time frame. Yeah, it does smooth out to have roughly the same slope depending on the time slice that we're looking at. Yeah, it still becomes a logarithmic curve. Now, that being said, it may not be identical. I mean, the steepness of that curve may be, and the duration of that curve may be shorter, but it does have that same, that has that same slope or that same shape. Now, we could really get into some weird stuff when we start talking about out of the money options and in the money options. We're not going to do that in this discussion. Let's jump into some examples here and let's see how this works for us. So I'm going to go ahead and I'm going to clear all those annotations, and we're going to jump into, let me come back and make sure that I'm not on my magic marker. We're going to change our grid down to our single grid, kind of our playground here. And the first trade that I'm going to look at in this particular case, the first example, is a long vertical spread where we're not splitting time, right? We're not calendarizing this trade, right? Yeah. Oh, for sure, George. Absolutely. Yeah, it is fractal, but the numbers changed a little bit. So let's take a look at this particular trade. Here's what I've got going on, right? So Disney's had an earnings. We've seen a big move to the upside, which means that volatility has collapsed. So volatility is low. And remember that volatility tends to be mean reverting. By the way, there's a feedback survey in today's chat. Michael's going to pin that to the top of the chat. Help me out. Fill out that feedback survey. It's 2 questions long. Doesn't take very long at all. Let us know what you think. That's how these sessions get better. So implied volatility is low with the potential to rise because it's down in the lower portion of its range. It tends to be mean reverting. RSI is up in that extreme. It keeps pushing to the upside, and we know that a trending stock can continue to move for some time. And then I've got a resistance level maybe up here right around the 116 mark. I'm going to kind of draw that line in. I've also got a resistance up here right around the 119 or 120. I'm going to call that 120 as a potential resistance, but I don't think that resistance is as strong perhaps as kind of this 116 resistance. I'm just going to kind of draw that line in here right about that 116. Okay. So we're going to build a long vertical spread that's bullish, which means that we're going to be using calls. And we're going to do that because implied volatility is low and it has the potential to rise. It's down in the lower portion of its range. Somebody might say, well, why wouldn't we use a short vertical spread in this particular case? And the reason that we wouldn't use a short vertical spread is that volatility has just been crushed and it's down in the lower portion of its range, so it's likely to rise. So a rising implied volatility number is likely to hurt a short vertical spread, but likely to help a long vertical spread. And our expectation is that the price of the stock kind of breaking out of this short-term symmetrical triangle, that pattern, something that Pat Mullally and I used to refer to as a cobra pattern, maybe indicates a bit of a breakout. Again, that symmetrical triangle squeezing between levels of support and resistance. We see this move to the upside, maybe up to this 117 mark or so. So that's what we're looking for. So now let's jump into the trade tab and let's kind of put this trade together. So the thing about this is a fairly short target. I mean, it's not very far away. So what we're going to do is we're going to come out here to the trade tab and we're going to look and see what our choices are and look to see what we have available. So generally, if we're going to put on a long vertical spread, we're going to keep in mind that consideration of the long side of the trade and trying to minimize the impact of theta. But we're already mitigating theta because of the short leg, right? That's kind of balancing that. So here's the thing, if we can get to a theta neutral position on this trade, then it really doesn't matter where in the expiration list we choose to put this trade on. So one of the things we might think about then in positioning our trade in terms of movement and in terms of expiration is if we go back to the chart and we say, look, here's our entry at 115, and we're looking at this moving to about 117. That's about a $2 move. So if we come back to the trade tab and we look over on the right-hand side and we see, oh, okay, 1 day to go until expiration, probably too little time to get to that $2 move, right? 8 days to go, that takes us kind of out beyond that $2 move. Maybe just to be safe, let's go out to the 6th December. That's going to give us about double that move. So a $2 move to our 117 resistance kind of falls right in the middle of that expected move within that time frame. And I'm kind of, hey, there you go, Carol. I appreciate that. The cute cobra. Nice. I like that. So we're going to go out 15 days to go until expiration, the 6th December expiration here. And we're going to build a theta neutral long vertical spread. So Joe asked the question, do I consider the ATR? To a certain extent, this is giving me a bit of a sense of what ATR is, but we could do that really quickly here. We could come down here and we could put ATR on a 14-day period on the chart. We can say, look, ATR is about $2.60. So that's about beyond right about where that target is, right? Absolutely. Yeah, so great question to ask there. A great confirmation is seeing whether we're within that ATR range. So we're going to go to the trade tab. We're going to open up the 6th December. I probably don't need 60 strikes. I maybe need 14 strikes here in this particular case. So I've got some pretty decent liquidity. These bid-ask spreads are fairly narrow. We're going to go to the call side. And so my expectation is I want the stock to go to that 117 or just a little bit beyond that resistance. So I'm going to start there at that 117 strike. That's where I expect it to go, right? And then what I might do is I might go 2 strikes wide here and look at that 115 strike, which is just about the at-the-money strike anyway, right? So if I go to the 117, we could look at selling the 117 first, creating that order to sell the 117 first, and then buying the 115, okay, putting that trade together. What I don't really know, though, is if that is theta neutral. We got to kind of get a sense of that. So I've got to change my layout, which I happen to have on volume and open interest right now. I'm going to change that layout to delta, theta, and vega. Those are the 3 important Greeks that I want to pay attention to here. So look, I'm selling the 117, right? That's got a 6-cent theta, and I'm buying the 115, which has a 7-cent theta. So we are net negative 1 cent of theta, right? So if we were to leave it at this particular point, then that trade is detrimented by each passing day by to the tune of about a penny. Now, if I can live with that, we might be okay with that. One of the things, though, that I might think about doing is shifting this a little bit, right? Instead of going, so let's come back down here. This is a little bit lower probability of success anyway, because it's got a lower delta on the short leg. But it's going to be a little bit less because we're paying less for the long leg. So our net debit's going to be less. So let's think about what we could do. If we wanted to make this theta neutral, which was our goal to begin with, right? We could go to the 116 strike, right? And get to that 116 strike, which is really only $1 away, right? And go to the 116 strike, sell the 116, which has a 7-cent delta, and instead of buying the 115, buy the 114, which is slightly in the money, higher delta, so more directional sensitivity. And so we could create this trade at the 116 strike and the 114 strike. Now we've got a $1.03 debit against a $2 wide vertical spread, so we're about 50-50. But it's theta neutral, so it doesn't matter when we put it on, because at the moment, theoretically, it is theta neutral, and it doesn't matter if time passes. So you know what we've done? We've just stopped time. Holy cow. When do you ever get to stop time, right? If only we could do that with our kids. Well, at some points in their lives, right? So we're going to stop time here with this because we've eliminated that theta sensitivity. What we've left with, though, if we think about our net deltas, if we think about our net Greeks here, we sold the 116 and we bought the 114, right? So we've got 0.61 delta on our 114 minus our 0.45, leaves us with about 16 cents of net delta, net positive delta. So if the price of the stock moves, that's going to benefit our trade. Let's look at our Vega number here. And we're at the 116, 114. And that is Vega neutral. So volatility doesn't matter really either. Volatility is at least not at the moment, right? This is a snapshot. So it's only delta sensitive, right? This particular trade, only delta sensitive. So let's pop this trade up here really quickly from the bottom. There it is right there. We'll pop that trade up from the bottom. And again, we're going to look at clicking on confirm and send, read through this order. It's about a 50-50 prop, but not really, relatively close to that. $1.07. Yeah. So Koala, that's exactly what we just talked about, right? It's expiring in 15 days. we've wiped out theta sensitivity. We've wiped out the sensitivity to the passage of time. That's what I meant when I said we've stopped time with this trade, because now the impact of the long theta is exactly balanced by the impact of the short theta on the short leg. So we don't in this particular case matter, or don't particularly care about that time sensitivity, that 15-day time frame. So I'm going to go ahead and we're going to click on send here, read through that order, make sure we're aware of it. Click on send, we'll fire that order off. And what we're looking for here in this particular case is the price of the stock to move. And we could put, so in this particular case, I'm not going to stop it on the downside if this starts to go against me. But what I might say here in this particular case is, look, we know that the most that this trade could be worth is $2, right? We paid $1 for it, right? Or $1.02 or $1.03 or whatever we paid for it, right? So if we could get out of this trade, I'm going to go back to the monitor tab and we'll go to our long verticals and diagonals section. And here's that Disney trade. So we paid $1.07 for it. It's currently trading for $1.15. It's going in our direction. If we can get out of this trade for $1.80 or $1.85, then we've picked up the majority of this trade, of the gain that we can get in the trade. So what I'm going to do is I'm going to right click and I'm going to create a closing order, and I'm going to sell this at a limit of $1.80. We'll call it $1.85. That's almost to $2. We're not quite getting to that maximum theoretical, which means that we don't necessarily have to wait. And if we get some volatility going here, those prices could move around enough that this fills for us. We'll make that good till canceled, and we'll click on confirm and send, read through this order, make sure that we're aware. Now, this isn't a stop. This is a limit order. It simply says, look, if I can get out of this at $1.85, get out of it. Right? If it's done the majority of the work that we can have it do. So that's sitting there and waiting to exit that particular position. Right? Cool. Okay. That was a short term or shorter term long vertical spread. Okay. Let's look at the same kind of thing with a long diagonal here. And what I want to do is I want to pop back over here to the chart. So look, it's already starting to move for us, right? And starting to make that move towards that 116 level. We're at 115.32. We're almost there. So we'll see if we can take that trade off and get that trade. So now let's take a look at Home Depot. That was a long vertical spread. Now what we're going to look at is a long diagonal spread. So a long vertical is two strikes separated, but in the same expiration month. A long diagonal is two strikes separated, but in different expirations. Okay, so that's what we're going to put together now. So here's what I happen to notice is we've got a bit of a downward move in Home Depot. In fact, I'm going to take this little resistance level out. I'm going to remove that. And I've got this kind of downward channel going on in Home Depot. So what I'm going to look for, and I'm kind of playing this as a double top in this particular case. So we've got a top right here. We've got a top right here. And my expectation is that this may make this move back down to this support level around, say, for instance, what is that? That's right about we'll call that support kind of the 390 mark, right? So right about the 390 mark. So I'm looking for this to move to the downside, but I don't know that it's going to make that move today. Again, implied volatility low and rising, and RSI kind of backing off, again, giving me a little bit of that bearish expectation. So here's what I'm going to do. I'm going to go to the trade tab for Home Depot. And once again, my expectation is this downward movement. Where it is now, 406 or 405, down to about 390. So that's about a 15-point move to the downside. So, Joe, the difference between a diagonal and a calendar spread splits expirations but not strikes. A diagonal spread splits strikes and expirations. That's the difference. So we're looking for about a 15-point move to the downside. So let's go to the trade tab and let's kind of look for the time frame that gives us maybe a little bit more than that 15-point move. That would put us out maybe to the 13 December expiration, or maybe to the 20 December expiration. Okay, so here's what I'm going to do in this particular case, because what I want to do is I want to give myself a little bit more time to maybe take this trade. I'm going to kind of bracket that time frame right here. I'm expecting about a $15 move. So I'm going to kind of bracket this 13 December expiration. And I'll show you why I'm going to do that here in this particular case, because I want the opportunity to stay in this trade if it continues to go bearishly. So what I'm going to do is I'm going to come out and I'm going to buy the 27 December expiration, and we're going to buy an in the money put option in this particular case. So I've got not terribly great bid-ask spreads, but I'm going to go to the 405 strike here, which is kind of the at the money strike. This is at 406. So I'm going to go to the 405 strike, and I've got less than $1 of a bid-ask spread here, right? So what I'm going to do is I'm going to buy that 405. We're going to buy that 405 put. The expectation is that the price of the stock is going to go to the downside. Now I'm going to come back to this December 13 or maybe even the December 6th, because I want time decay to work a little bit faster here. So I'm actually going to come to that one that's 15 days. That gets me almost to that $15 move. And so what I'm going to do is I'm going to go to the 6th December expiration, and we're going to sell where that expectation is, right? I'm going to sell in this particular case where I want this strike to go, or the stock to go, which is down here at around the 390 strike. So I'm buying the 405 and I'm selling the 390. And now I'm creating this long put diagonal. So this is a $15 wide vertical spread, right? And I'm paying $7.56. So I'm paying about half of the width of that spread to get into this trade, right? And if I right click on this and I go to analyze trade and I take some of these others out of here, whoops. Let's create that trade again. Let's go back down here. Whoops, let me go to there it is. We'll right click and we will send that to the analyze tab. Now we've got that diagonal spread. And let's pop this back down. Let's take out our long stock position. And here's the characteristic shape of a diagonal spread. I want, the way I get maximum theoretical gain in this particular case is if the price of the stock goes to that short strike, the 390 strike. But I've got this area where if it continues to go higher, or excuse me, it continues to go lower, I'm still locking in some potential gain here. Where I lose is if the price of the stock goes up. I don't want the stock to go up in this particular case. So I'm putting this trade on with the expectation being that the price of the stock is making that move to the downside. So let's pop this trade on and we'll see how this works. If I click on confirm and send, you can see that I know what the cost of the trade is, but I don't know what the break even is, and I don't know what my maximum profit is. I can estimate my maximum gain, but I can't know it exactly because of the fact that these are two different expirations. So if I come back over here and I go to my Analyze tab and I say, look, if this goes to 390, my maximum theoretical gain in this trade is about $9.63, right? $9.63 or $9.63, $9.71. Theoretically, kind of move that around a little bit. So, all right, cool. Because I know that the width of this spread is $15 and I've paid about $7 for it. So if I could get out of this trade, so if we were to do this and I were to make this a first trigger sequential and now make an opposite order, and if we were to get out of this trade at a limit, if I could say, look, if I could get out of this trade for, we know that the max width is going to be $15, so that's the most that it could trade out. If I could get out of this trade at $12, then I've taken the majority of the gain out of this trade, and I'm going to make that good till canceled. We're going to click on confirm and send, read through that order, make sure that we're aware of that. Now, remember, This is an equity option, so we could be, this is an American style option. So we could be assigned early, right? We could be assigned early. If that happens, great. You know what? That's a situation that gets us to that maximum theoretical gain, right? So I'm going to go ahead and I'm going to click on send. The reason I'm not doing a long put vertical in this particular case is I want to extend the duration if this continues to move to the downside. I want to have a little bit more time on that expiration. Plus, I want to have a little bit more sensitivity to a rise in implied volatility because I expect the implied volatility is going to rise if this stock continues to move to the downside. So we're going to go ahead and we're going to put that trade on and see if we can get into that trade. But that would be the reason why we would do this as a diagonal as opposed to a vertical. Okay. All right. So now those are the two trades that we've got on here, right? We've got a long put vertical, or excuse me, we've got a long put diagonal on Home Depot, and that just filled for us. We got it for 758. And I've got that long call vertical on Disney. Remember what I promised you that I was going to do? I promised we were going to look at a 0 DTE or a 0 days till expiration index vertical spread, right? Long vertical spread. So here's what we've got going on. We've got XSP, which is the micro or the mini version of the S&P 500. Trades the same. It moves the same. It is European, or its options are European style, but this is a cash settled index, so we can't buy the index. But what we can do is trade this. Now, the great thing about this from an activity perspective is if we go to the trade tab for XSP, we see that it's got expirations every weekday. So we could trade a vertical spread, or we could trade a trade that expires every single day. Now, here's the thing. We know that on the day of expiration, at the end of that time frame, all the time value is going to be gone, right? So we're not really concerned about time decay. We know it's going to happen. We just accept that as a constant. So what we're looking for here is directional movement. We want to be able to take advantage of some of that directional movement. So what I'm going to do is I'm going to go back to the chart, and I'm going to jump down in time frame to the sub-daily range. Now we're going to be looking at this sub-daily range, which is intraday. So I'm 5-day, 5-minute chart here. And what I notice is happening as I start to see this is we've started to see this run to the upside. We might be seeing this little bit of a bull flag type of scenario happening here, right? Right. So rally up, it's pulling back. It's maybe starting to bounce a little bit here off of this support level. RSI in this short term is starting to move to the upside. We can use other different sub-daily tools here, but I'm going to look for this to make a quick move to the upside. It's bouncing up off of this kind of 490 or 593 support level here. I'm going to look for this to make a quick move to the upside. Now, we're past the first hour or so of the day, so most of that volatility has kind of settled out. You can see that early in the day, this went down, it went up, and you know, as we kind of look at this, but it's kind of picking a direction here. Now, Brad asks a great question. The Disney trade was a little bit shorter, so a little bit less uncertainty. The long trade, the long diagonal, with a lower probability or lower percentage gain, that doesn't take into account the opportunity for me to roll that trade and stay in the trade. So I'm looking at a lower gain on that first iteration, maybe a larger gain on the second iteration. Good question to ask. Okay, so now let's take a look here. If we're picking a direction, we're looking for this to make a move to the upside. Where might it make a move to the upside? Well, I had this opening print right up here around the 595 or so. I'm going to call it 595, which also happens to be kind of this resistance level back here. So I'm going to call it 595. So all we're looking for is a short move up to that 595. So we're going to go to the trade tab, and we're going to come down here to the one that expires today. Okay, I already put a trade on earlier that's going against me on the put side, looking at this trading that downside movement. Now I'm going to look for this to make that move up to 595. So what I'm going to do, if it's bouncing off of the support at 593, I'm going to buy the 593 and I'm going to sell the 595. That's where I want it to go. So I'm going to pay 88 cents roughly for a $2 net or a $2 wide vertical spread. And my expectation is that really all this needs to do is move in order to get there. I'm willing to risk that 88 cents for the sake of this trade going to its maximum theoretical gain. Now, here's the thing to think about. I've got the 595 and the 593. It is theta, essentially theta neutral, although that in the money option, or what's the at the money option, has a pretty high theta. But you know what? I don't care, because this is a 0 DTE, so all of that time decay is going to happen today at probably closer to the end of the day anyway, so I'm not all that worried about it. It's not Vega sensitive at all, because Vega is a push here, plus 5 cents, minus 5 cents Vega, and so that really is a push. So what I'm left with is about 21 cents or 23 cents of net delta sensitivity. So this is net delta sensitive, so it is directionally sensitive. So this is a one and done. There's no rolling. I'm willing to risk what I'm risking in this particular case and looking for a potential gain in the trade. So I'm going to pop this up. Now, what I'm going to do is, I know that the max width that this can be is $2, right? The max that this spread can trade at, because of the width of the spread, is $2. So I'm going to do the same thing. I'm going to do a first trigger sequential, and I'm going to create an opposite order, and I'm going to say, look, if I can get out of this at a limit price, I know that the most that I can make is $2 on the trade. If I can get it out of this at a limit price of $1.85, okay, so about $1 gain in this particular case, I don't need to set the time and force, because this is a one and done, because this is a 0 DTE, to the certain extent that I'm willing to risk the amount that I'm willing to risk in the trade, which in this case is 95 cents, right? Now, we could maybe work that a little bit and make that limit a little bit lower, but it's going to mean that we're not going to get filled necessarily right away if that price is moving. And the price is moving on us because this is moving to the upside. So I'm going to go ahead, I'm going to open up that lock, and I'm willing to take this trade. We're going to go ahead and click on confirm and send, read through the order. Max gain is balanced here. I'm going to put this in my 0 DTE, and we're going to go ahead and send this order off. And it filled for 98 cents. We've got an order to take it off at $1.85 if it goes in our direction. If it doesn't and it expires worthless, we're out the $98. Now, here's the thing. If this were an equity option, there would be a greater potential. There would be a greater potential for us to be assigned early, because we're close to expiration, close to the at-the-money position. But you know what? In a long vertical spread, that puts us into a theoretical maximum gain scenario, number one. And number two, in this particular case, this is a European-style option, so it can't be exercised until expiration, so we don't have to worry about early assignment. So if you had under $25,000 in your account, because it is substantially similar, it would increment that day trading or pattern PDT count. If you have more than $25,000 in your account in liquidity or cash equivalents, then you wouldn't have to worry about that. So something to keep in mind. But 0 DTE trades, if you're putting it on and you're selling it and then you're doing it again, that's going to increment that PDT time frame. So let's keep that in mind as well in thinking about this, and something to pay attention to. But guys, that's where we are. That's what we've done, and I hope that was a little taste of that scenario. If you want to learn a little bit more about those ideas, pop over here to the Trader Talks webcast channel. By the way, good opportunity to remind you to subscribe to the Trader Talks webcast channel if you haven't already. But jump in here and type in 0 DTE if you want to learn more. And I've got even a playlist of 0 DTE webcasts that you can jump into if that's something that has intrigued you. But we've talked about long vertical spreads on a shorter time frame. We've talked about long diagonal spreads on kind of an intermediate time frame, and we've talked about long vertical spreads on a very short time frame, including that sub-daily time frame. Guys, thanks for being here. Remember to click on that feedback survey and fill that out if you haven't already. And we will see you guys again very soon. Thanks to Michael Fairborn. Thanks to our great production staff. Take care, everybody. Bye-bye.